Welcome back to Futures with Lichtenstein and Hinks. I want to have a look at some of the recent price activity in the dollar and the foreign currencies. For more on a look at the dollar and foreign currencies, I'd like to welcome our guest here today, Todd Horwitz. Todd is Chief Strategist of BubbaTrading.com. Todd, welcome to the show. I want to talk dollar first. Fed meeting this week, quarter-point hike already priced in. Now what? Does the Fed shift focus to the 3 hikes in 2018, or where does this leave us?
Good morning, Hanks. And Lichtenstein, I think that we're going to see the verbiage will be very important. This is Janet Yellen's last official press conference. She could say just about anything. Now, if they stay the course of which they've been, it means more free money, more slow money, less movement, which is why I think we're seeing the bonds being priced a little bit higher than they should be, and the dollar a little bit stronger because they're going to hike rates here. We'll see where this all brings us from here, but if they show any hawkish tones, I would expect the dollar to start to really spike up and get back to that. Now, tried to go through a couple of weeks ago, which would put a lot of pressure on the euro currency as well.
Good morning, Todd. Yeah, you're right. The dollar is the big trade, I think, coming out of this. But correct me if I'm wrong. In some of the past Fed rate hikes, right, bonds and the dollar have moved the other way once the announcements come out. Is there any chance of that happening, or do you see a stronger dollar into the end of the year?
Well, I think we're going to see a stronger dollar in general. I don't really know. I don't really think the announcement is going to be all that big. If the announcement is hawkish, that could push the dollar through 95, which is where it stalled last time up. But if it's just what it's supposed to be, which is what's expected, the dollar has bounced off the bottoms at 92, 92.50, and has started to push its way higher anyways. So I think the dollar maintains. Now, the real curious thing here is what the bond market is doing, because the bonds have been basically rallying a little bit, the futures, which means interest rates have been falling, and that doesn't make a lot of sense, knowing that we have a hike in front of us in 2 days.
Yeah, you know, Todd, I'm curious. I'm completely there with you in terms of that dollar. We've been watching the 95 to 91 area, range-bound type chop. I'm curious. We've just nailed. What should we expect to hear out of the ECB this week?
Well, they're going to continue to do whatever it takes. So there's a lot of issues in the euro right now. I mean, you've got, you know, their overall, the leaving of the Brexit divorce, Catalonia, and all the other things that are going on. They've got some real issues there. And I think that, you know, Mario Draghi will continue to do whatever it takes. So that could either push the euro back up to about the 120, 121 level, or this could be the end of the euro. I mean, I personally believe that the euro is going to fall, and we're going to get down into the 114 and even lower than that as the year goes on next year. I think the dollar is going to be much stronger. I think everything's setting up for a much stronger dollar. I think there's a lot of fear that is underneath the surface of the markets, and that's where people run to, which is the Treasury bonds and the U.S. dollar. And I think that's what we're going to see is more fear in this market, even though it hasn't showed up in the volatility index yet.
All right, Todd. Now, you know, the whole discussion about the Fed and rates, and, you know, there's an inflation discussion to have here, right? Even though we had a payroll number that was outstanding, the only part of that number that was at least a bit disappointing was the inflation number, the wage number, right? Are we getting ahead of ourselves here? I think we're just normalizing rates, but when can we expect inflation to start creeping into this market, if at all?
Well, I think the biggest problem is, you know, I agree with JJ that the inflation pressure, the wage pressure is terrible. We have lousy wages because we're really creating lousy jobs. We haven't had a great jobs number that showed great jobs where we're making a lot more money. So I think that's a problem, and I think this artificial inflation that the Fed wants to create, which is taken away from the lack of true free markets right now, because right now, why are the markets trading cheap? Anywhere but the equity markets. So if we continue to see only the money being forced in equity, we're not going to see inflation, because you're not having a natural, true, free price discovery market, which allows us to see markets flow truly. Until the banks can provide liquidity and allow small businesses to come back into play and let them borrow money, we're not going to see the inflation pressure they want, because the bottom line is small businesses are the businesses that pay better wages, and they are the ones that allow us to move forward. Without that, and with the continuation of this lowered cheap money where we only have the major banks in play, that's going to continue to keep pressure on inflation, and we're not going to see it. Just look at the commodity markets.
Todd, I want to talk real quick about Treasury markets. I want to talk about the impact that the Fed unwinding is going to have on the markets. We've been seeing yields on the rise here, especially in the 2 and the 5. What are your thoughts? Do you expect this to continue?
Well, I think this is another problem that nobody talks about, and that's the flattening or the possible inverting of the yield curve. You know, the short-term rates are rising and long-term rates are falling. That's not a real good situation. That's not healthy for the overall economy. I think it's probably going to continue because, as the Fed has done, they have never really made the right decision when it really counted. So I think this is going to be an issue, and this may be what eventually leads the equity markets to a potential correction, because we're not seeing real true growth throughout the economy. Everything that we've seen so far has been growth based on companies buying their stock back and things like that. So if we continue to see this pressure, and if this yield curve continues to flatten or actually inverts, that's a recessionary sign, and that could create some bigger problems down the road.
All right, we'll keep a close eye on those Treasury markets. Todd, I want to thank you for joining us here today. Thanks for taking the time, and we hope to have you on the show in the near future.